Financial experts and billionaires have been warning of an economic slowdown. One of these is Billionaire Hedge Fund Manager Chamath Palihapitiya. Speculations reached dangerous heights as the Fed issues huge amounts of money into the economy. Inflation began to rise and financial markets soared to new all-time highs. Many fund managers, economists, and ordinary investors have expressed concern about this. According to Chamath, investors should be looking at a totally different indicator. In a frightening turn of events, the Federal Reserve is adamant about cutting its balance sheet and raising interest rates to combat inflation. Millions of people around the world have called out inflation as not being transitory, but looking like those worries may be a self-inflicted prophecy. Chamath believes that inflation may actually turn out to be more transitory than people are expecting, just because the Fed may overreact. Famous investor Jeremy Grantham has been warning of a market crash for America's super bubble. Grantham explained how the market has been stabbed by COVID, money printing, unexpected inflation, and the promise for higher interest rates. The economy is in bad shape. Chamath believes that the Fed will likely overreact, resulting in a recession in the United States. If stocks continue to fall as a result of higher interest rates, the net money outflow could become negative. Growth stocks and cryptocurrencies have both plummeted in value in recent months, demonstrating this. David Sachs, a famous venture capitalist, explained why a recession is imminent, which Chamath agreed with.
We had Jeremy Grantham, who's sort of a
old school
kind of bearish type market commentator. He had this expression that it's more one of these stop clock right twice a day things.
Jeremy Grantham has never found a market he didn't name.
Yeah, exactly. But a stop clock can be right twice a day. And the line he had today is that we're seeing the popping of a super bubble. And we've been talking about
super bubble.
Yeah,
Evocative.
Exactly. Basically,
but that's not true. But I mean, it's good.
Yes,
well,
it's evocative.
Well, the sense in which it might be true
Super
is
bubble.
that we talked about this last few months. Is that you had the Fed and the federal government pump a 10 trillion of liquidity into the market over the past 2 years because of COVID. Now they're starting to pull that back. And there was, I think, a general asset inflation across asset classes. Certain types of assets clearly got more inflated than others. We've seen a huge correction in growth stocks. We've seen a huge correction in crypto. Basically anything long dated, as the fear of interest rates increasing has gone up, they've massively corrected. But so the concern is that, with the losses we're seeing, and every day I keep seeing more red, that this could turn into a recession. Popping of bubbles is usually followed by recessions. So I think, the fortunes of the economy could turn really quickly here. And
that is the marginal risk. The marginal risk is actually for a recession. We talked about this before. By the way, just to your point, you're right that we pumped in $10 trillion, but over the last 3 weeks, and really over the last 2.5 months, we have actually eviscerated $10 trillion of value as well. So if you want to measure it, we put 10 trillion of excess capital in, but we've now destroyed $10 trillion of equity.
Destroyed it by lowering the prices or repricing stuff. Yeah, we've repriced
equity,
everything.
Crypto. Crypto in the last couple of days has just been shellacked.
Yeah.
Growth stocks have been shellacked. Biotech stocks have been just absolutely smoked. Everything is getting.
You might think that interest rates are increasing around the world, but that's not the case. While the U.S. Federal Reserve has been increasing interest rates, China has actually been lowering interest rates. This is concerning for one reason. The Fed raising interest rates could indirectly crash China's economy. Because China represents a significant part of the economy, a crash in China's economy would hurt America's economy as well. China is also being impacted by Omicron, as the Chinese government has been extremely strict on shutdowns. The result, China is rapidly slowing economic growth. The People's Bank of China will likely cut the bank's reserve requirement ratio soon as well. A reserve requirement ratio, or RRR, is the percentage of deposits that banks must hold on to. In this example, the reserve requirement is 8%. If the reserve requirement goes down to 6%, then the bank can loan out or invest 2% of excess reserves. On the flip side, if the RRR goes up to 10%, banks will have to sell a portion of their holdings to meet the requirement. China's reserve requirement used to be 12% before they lowered it to 11.5% in December 2021. This is a sign that the Chinese economy is struggling and that artificial cash inflows are necessary to keep the economy running. Economists have also warned of 2 or more RRR cuts this year. So while the Fed is raising rates and the Chinese government is lowering rates, the US dollar will go up while the Chinese yuan will go down. This puts a substantial amount of pressure on the People's Bank of China. We saw a similar situation happen in 2018 that led to a mild manufacturing recession for the US. While that happened, China's economy experienced the slowest growth in 28 years. So how did all this happen? In 2018, Jerome Powell raised interest rates in the middle of a trade war, causing the Chinese economy to slow down substantially. This forced the Fed to lower interest rates in 2019 as the global economy decelerated significantly. US manufacturing production suffered as a result and entered a mild recession.
Risk, in my opinion, is not of runaway inflation anymore. And the reason was what happened this weekend was incredibly important. And we have seen this happen just a few years ago. So this weekend, China cut interest rates. Now, as we know, we are dealing in the United States with this issue of whether we should raise rates and by how much because we're worried about inflation. Well, if you're cutting rates, it's because you're worried about the other problem, which is that the economy is basically turned over and you need to become more accommodating, right? You need to incentivize businesses to spend by lowering.
By turned over, you mean it's slowed down. People are not building, companies not doing new projects. So you want to give them an incentive or maybe some catalyst to start some new company or start some new project because all their real estate projects have wound down.
In 2018, here's exactly what happened. The setup was the Fed, everybody was worried about what the Fed was going to do on interest rates. The Fed was looking at China as the canary in the coal mine, the leading indicator of what we should do. And at the end of 2018, Jerome Powell decided to raise rates. And we raised rates. And then enter 2019, and the Chinese economy turned over. And we realized that their economy was not nearly as strong as we thought it would be. And so our reaction was disproportionate to what the actual data on the ground said. We entered a recession in 2019. That's when you guys probably saw Trump going crazy, blaming Powell. I mean, most of us ignored it because, we were all dealing with, Trump derangement syndrome. But the underlying thing of what he was saying was, hey, hold on a second. You just caused a recession in America by raising too quickly. The Fed is now in this really delicate situation where China cut rates last week. We have an FOMC meeting, the Open Markets Committee that sets rates on Wednesday, I think, of this coming week. What is he supposed to do?
Aside from China, Germany is also experiencing a slowdown. The German government also forecasted that Germany's output for the year would be higher than expected, after its decline on 0.5 to 1% in the fourth quarter of 2021. Germany's GDP growth projection for 2022 has been lowered to 3% from 4.1% previously.
This past weekend, actually, Germany decreased their GDP forecast. And so you're starting to see two huge countries already say, hey, wait a minute, we need to be, more realistic about what long-term growth looks like here. It's inconceivable in my mind that those countries are slowing down and we won't. And so I think what happens in these other huge GDP drivers of world GDP will affect us. And so, Sachs and I have said this before, but the marginal risk will be that we overcorrect and actually create a recession that doesn't need to be one.
Some investors might assume that when the Fed raises interest rates, the market bottom will be nearby. However, that's actually not the case. Market prices are forward-looking and therefore price in future events. Investors know that rate hike is coming and that's being reflected in the market right now. Chamath found out that the market actually tends to increase after rate hike occur. That being said, perhaps rate hikes are already being priced in, and it's to start dollar cost averaging into the market.
FOMC meeting happened this week, and Powell basically said, look, we're going to start tightening in March. I think the way that he said it, all of these words tend to be so scrutinized and overanalyzed, but instead of figuring out what people thought, I think their actions post the FOMC are important, which is that, we effectively now started to price in about 5 rate hikes this year. So probably 5 25-point rate hikes. Effectively, that's what the yield curve tells us. If you take a big step back, I just want to remind people, it's really hard to live through volatility, right? And we're in a phase of it now. But typically these big drawdowns, so when stocks go down, it actually precedes, so it comes before the actual starting of a rate hike cycle. And so if you go back to from 1950 onwards today, every time the government has started to raise rates or the Federal Reserve has started to raise rates, the stock markets have actually rallied. Now, why is that? It's typically that they see through the end of the rate hike cycle and they start to price the business as if these rate hikes are done and to rebase things. And on average, I think the stock markets go up between 7 and 8%. So call it 7.5%, 8.5%. And so what's interesting to me is now we're finally starting the process of these hikes. And the real question is going to be, how data dependent do these guys get?
Bill Ackman, a famous hedge fund manager, has been pressuring the Fed to raise interest rates even more than expected. Ackman has a short position in the bond market and would benefit if the Fed listened to him. However, that doesn't come as a surprise because Bill Ackman is known for manipulating the market. So we know that the economy may go into a recession, but that doesn't really translate to a major market crash.
2 weeks ago was advocating for a 50 basis point raise in this meeting. So that's way beyond what people even thought is supposed to happen.
We should just remember that Bill Ackman has bets, macroeconomic bets in the market. If he's calling for a 50-point raise, I guarantee you
he's going to make a lot of money.
He'll make a lot of money if there's a 50-point raise.
No conflict, no interest. Yeah.
Exactly.
But my only point is the setup is a very complicated one for the Fed coming into this week. And the risk is to a recession because if we overcorrect,
yes,
and the leading indicators all around the world tell us that their economies are weak, then inflation may have actually been much more transitory than we thought. And right now we have to decide, because if we overcorrect, we're going to plunge the United States economy into a recession.
The mild recession that America experienced in 2018 led to a 17% decline in the S&P 500. That's not huge at all. And one of the reasons why is because there's a lot of money on the sidelines. Total savings at all depository institutions have increased to over $11 trillion over the last 10 years. Even if the market crashes, as much as it did during COVID, it would likely rebound relatively because of the cash waiting to buy the dip. Not only that, but plenty of tech stocks have already crashed by humongous amounts. 40% of the stocks on the Nasdaq have crashed at least 50% from their highs. That level of decline is almost in line with previous economic disasters. Chamath believes that once big tech goes down 10 to 15% more, the market bottom will be nearby. We've witnessed Meta go down 26% in a single day, which is a major signal that big tech isn't as strong as people have anticipated.
The bottom of the market, and it was a phrase something like, when we shoot the generals, and his comment was the generals are big tech. When those things trade down 25%, the bottom is in. And I think that collectively, most people think that we're a little bit oversold in all areas except big tech. I think big tech is down 10, 11, 12%. When you see this thing really get cracked is when those folks, trade down another 10 or 15%. And then I think we're kind of through most of the pain.
So Peloton and Zoom were kind of mid-tech. I don't know what we call those, but I would call them like mid-tech. They're obviously not big tech, but they're not small either. Mid-tech gets their asses kicked 50 to 80%. Big tech, 15%. But if big tech goes down 30%, then we start really seeing a bottom. And we consider Netflix part of that?
I don't think you'll ever see that because I think big tech, you have to remember, is basically the index. And in the last 10 or 20 years, you've never seen drawdowns more than 15 to 25%. You've never seen it. And when you've ever had a 15 to 25% drawdown, meaning the market goes off 15 or 25%, you have to remember the thing that we have also done over the last 20 years is created so much money on the sidelines, always looking for a cheap buying opportunity. And so the minute that these things, so even, in March of 2020, remember when we started to do this pod and it literally looked like the world was ending?
Yeah.
The bottom existed for a week.
Yep.
And then within a week, the entire 25% loss in the stock market was wiped out and we were back to normal.
To make matters even worse, businesses have ordered too much inventory due to supply chain issues.
You're bringing up a really important effect of all of this, which is what happens now in 6 or 9 months, to your point, when the consumption of hard physical assets turns towards the consumption of services, which it typically does, right? If you revert back to the mean here, people aren't going to be buying as many Pelotons and all of that stuff because they bought them all, right? They bought all the physical goods they need. And to your point, these companies have over-ordered all this inventory. Actually, Peloton is a perfect example because they basically shut down their entire supply chain at the end of this past quarter and essentially said our inventory turns will be more than enough to meet existing demand for the foreseeable future. That's an enormous capital problem that these companies now all of a sudden will face, right? So the next step beyond all of the supply chain issues could be, and I think Sachs has been talking about this a lot, like a pretty bad recession if these companies have all this inventory and they don't know how to get working capital.
The interesting part of this market turndown is that a large percentage of the crash is instigated from people hedging their portfolios. Almost all top-tier fund managers are hedging their portfolio in some shape or form. The initiation of these hedges is likely negatively impacting the market. These hedges have a considerable impact on the market and could be the driver for the current correction. Chamath mentioned how this is the most hedging activity that he's ever seen since the 2008 recession.
We have had more activity and hedging than in any other period in recent memory except the great financial crisis. Just to set the tone of where we are in terms of volatility in the capital markets. Mutual funds who don't short stocks, right? The multi-trillion-dollar mutual fund complex whose only job is to buy has been a net seller. Hasn't even started buying a single thing yet.
Like Chamath mentioned, even if the market crashes further, it won't last long because there's simply too much cash on the sidelines. Like I mentioned before, in the 2018 market correction, the market only fell by around 17%. Nobody knows how large the crash will be, but it could be as small as the 2018 correction. Now the prices are correcting, the dust is settling down, and rate increases are being priced in. We may believe that the market will reach an inflection point when inflation falls, and that the rate hikes will stall if not reversed. It's tough to pinpoint exactly where the point is. Extrinsic factors such as a global economic downturn caused by China could also play a role. If that happens, I'll simply increase my dollar cost averaging. Please share your thoughts in the comments box below. Do you agree with Chamath's point of view? Please hit the like button and subscribe if you like this video. This is Top Tech and Trades, and I'll see you in the next one.